Every year, millions of Australians pour money into broad-based ETFs, chasing the dream of easy, hands-off wealth building. Buy the index, hold forever, let compounding do the work. That's the pitch. And for the most part, it works. But here's what almost nobody talks about. The tax side of ETF investing is far messier than the marketing suggests, and small mistakes here can cost everyday investors thousands of dollars a year. Today, 5 of the most common and most expensive ETF tax mistakes Australian investors are making right now. Stick around, because the 5th one exposes a blind spot that even seasoned investors miss, and there's one tool that can fix all 5 at once. Let's start with mistake number 1, using FIFO without realizing the impact. FIFO stands for first in, first out. It's the default method most accountants and most investors use without even thinking about it. When you sell shares or ETF units, the system assumes you're selling your oldest parcels first. Simple, logical, and completely automatic. Except here's the problem. The Australian Taxation Office doesn't actually require FIFO. Investors are allowed to choose from several cost-based methods, including FIFO, LIFO, that's last in, first out, maximize gain, minimize gain, and minimize capital gains tax. Most people never even know this choice exists. Consider a real-world style example using BHP shares purchased across multiple parcels over several years. Using the default FIFO method, selling a portion of that holding might trigger a capital gain of around $13,124. Now, apply the minimize CGT method instead, which deliberately selects the highest cost parcels first, shrinking the taxable gain, and that same sale might produce a gain of only around $4,300. That's a difference of roughly $9,000 in taxable gain from the exact same trade, just by choosing a different accounting method. So how does minimize CGT actually work? Instead of assuming the oldest shares are sold first, it scans every parcel in the holding and picks the ones with the highest original purchase price, the ones that will generate the smallest gain or even a loss, and allocates those to the sale first. The lower the gain, the lower the tax bill. But there's a caveat worth remembering. This strategy has a shelf life. Eventually, the high-cost parcels run out, and future sales will be forced to draw from the cheaper, higher-gain parcels. That's why smart investors think ahead, deciding, year by year, whether they want a low-tax year by using minimize CGT now, or whether it makes more sense to bank a gain deliberately in a year where their income is lower. Now, mistake number 2, not tracking AMIT cost-based adjustments. Most ETFs in Australia are structured as Attribution Managed Investment Trusts, or AMITs. Each year, usually arriving by email or through the broker platform around July or August, investors receive a member statement, sometimes called an AMA statement. And here's the trap. The ATO's pre-filled data usually does not include one of the most important numbers on that statement, the cost-based adjustment. These adjustments can increase or decrease the cost base of every single parcel purchased during that period, depending on the fund's own tax position for the year. That might sound minor until multiplied across a real portfolio. Picture an investor who's been dollar-cost averaging into a single ETF for 3 years, buying small amounts every month. That's 36 separate parcels. Every one of those parcels needs its own pro rata adjustment applied every single year. And it compounds. Each year's new adjustment doesn't just apply to that year's purchases, it can retroactively affect the cost basis of every parcel bought in prior years too. Do this manually across dozens of parcels, across multiple ETFs, across several years, and the room for error is enormous. There's a second overlooked line item hiding in the same statement: capital gains passed through from the fund itself. Even if an investor never sold a single unit, the ETF may have realized gains internally and passed a taxable capital gain straight through to unit holders anyway. Skip this line, and a real tax obligation simply disappears from the return until the ATO's data matching catches up. Mistake number 3, failing to harvest losses. Capital losses aren't just a bad outcome to write off, they're a tool. Realized losses can directly offset realized gains, reducing the tax bill for the year. Yet most investors never actively look for this opportunity. Picture a portfolio currently sitting on a net capital gain of around $1,155 for the year. Running an unrealized gains and losses report across the whole portfolio, essentially simulating what would happen if everything were sold today, reveals around $521 in losses sitting quietly, unrealized in underperforming positions. Zooming in further, one particular holding, a BHP position bought at a higher price than today's market, is sitting on an unrealized loss of around $437. Selling just that position would trigger a real deductible loss that offsets a chunk of the year's gain. And because it's an ETF or share position, there's nothing stopping an investor from simply buying back in later, subject to the usual market timing considerations. This is where an AI-assisted portfolio tool becomes genuinely useful. Simulating a hypothetical trade, what happens if $1,000 of BHP is sold right now, can instantly estimate the resulting tax liability, in this case, landing at roughly $84. That kind of instant modeling turns tax loss harvesting from a once-a-year accountant exercise into an ongoing proactive strategy. Mistake number 4, terrible record keeping. Every cost-based adjustment, every CGT method choice, every claimed loss needs to be provable. If the ATO ever asks, and audits and reviews do happen, sometimes years after the fact, trust me isn't a defense, documentation is. Spreadsheets feel manageable at first, until dollar cost averaging, dividend reinvestment plans, and frequent trading start generating dozens, then hundreds of individual parcels. At that scale, a manual spreadsheet becomes a liability rather than a safety net. One wrong row, one dropped parcel, and the entire cost-based calculation can be wrong. It gets worse when brokers change. Switching platforms doesn't transfer trade history, only current holdings move across. Imagine a CBA shareholding originally purchased through NAB Trade years ago, then partially sold through ComSec, with the remainder later moved to a platform like Perler. 3 different brokers, 3 fragmented pieces of history, and not one of them holds the complete picture on its own. Dividend reinvestment plans compound the mess further. Each reinvested dividend creates a brand new tiny parcel with its own purchase date and its own cost base. Over several years, a single DRP-enrolled holding can splinter into dozens of these micro parcels. The ATO can ask for proof of cost-based calculations well after the fact. Good records aren't just tidy, they're protection. And finally, mistake number 5, assuming the broker handles everything. Broker platforms are excellent at showing account balances and recent trades. What they're often surprisingly bad at showing is the bigger picture. Total dividends earned across the life of a holding, and true annualized performance. That distinction matters more than it sounds. A 50% return sitting on a screen means something completely different if it happened over 1 year compared to over 10 years. Without annualizing, it's almost impossible to judge whether a holding is actually performing well. There's also a dividend return blind spot. Some ETFs or shares can look completely flat on a price chart, barely moving for years, while quietly generating solid real returns through consistent income distributions. Judging performance on price alone misses half the story, sometimes more than half. For anyone holding international shares or global ETFs, there's one more layer most brokers never surface clearly: currency movement. An Australian investor holding something like Apple or Tesla isn't just exposed to the share price in US dollars, they're also exposed to the AUD-USD exchange rate. If the Australian dollar weakens against the US dollar while the stock price is flat, that currency movement alone can turn a break-even position into a real gain. Flip the exchange rate the other way, and a genuine share price gain can be partially or entirely wiped out once converted back to Australian dollars. Most standard broker reporting simply doesn't separate these two effects, so investors often have no idea which one is actually driving their result. So there they are, 5 mistakes quietly costing Australian ETF and share investors real money every single year. Blind FIFO usage, ignored AMIT cost base adjustments, missed loss harvesting opportunities, fragile record keeping, and broker blind spots around dividends and currency. The common thread running through all 5? Visibility. Every one of these problems becomes far less costly once there's a clear, accurate, real-time view of the full portfolio, every parcel, every adjustment, every currency exposure, all in one place. This general overview is for educational purposes only and isn't personal financial or tax advice. Individual circumstances vary, and speaking with a registered tax agent or financial advisor is the best next step before acting on any of these strategies.